The term real estate professional sounds very generic, but here in the United States, there's a specific definition of real estate professional where if you conform, you've got tremendous tax benefits that are going to save you potentially hundreds of thousands of dollars a year. This video is going to explore what it means to be a real estate professional. So what does it mean to be a real estate professional? Well, here's the thing. Many people spend a lot of time investing in real estate, but they've also got a job. So if they've got, say, a part-time job, they're putting 30 hours a week into that, and they're spending a lot of time looking at real estate deals, buying them, transacting them, they might find that if by classifying themselves as a real estate professional, and you have to have a certain minimum number of hours that you conform to qualify, by doing that, the ability for them to deduct expenses goes through the roof. And whether you're operating at millions of dollars a year or just maybe $50,000, the difference is significant in tax deductibility. It is worth considering. Let's see what it means to be a real estate professional. When you play the game of real estate, you have lots of tax deductible losses or things that you could potentially claim. You've got depreciation, you've got all your travel, going out looking at deals. You've got dining, it might be wining and dining a buyer or a seller or a potential tenant. You've got your home office that you're dealing with. You've got mortgage interest when you invest yourself. And you've also got the situation where tenants pay for what you're doing. They effectively pay the mortgage up for you. But you've got a lot of expenses. And if you already have a full-time job or a part-time job, you may not be able to claim all those expenses. However, if you can be reclassified as a real estate professional, according to the IRS, then suddenly you can claim all of those expenses. According to the IRS, there are three classifications of investor. The first is a passive investor. This could be someone who's got a property that is out on the rental market. However, it's being managed by a management company. So he can still claim any passive deductions, such as depreciation. But if he goes out to dinner, he can't claim that dinner as a tax deductible expense because it wasn't incurred generating a tenant or finding a new property to invest in. He is purely a passive investor. The second classification of investor is an active investor. And this is a pretty easy definition to make. An active investor is someone who actively makes decisions. For instance, he might own that same property, but instead of having a property management company look after it, he looks after it himself. He vets the tenants. He calls the electrician and the plumber when something needs doing. This is an active person, and in this case, you can deduct all your expenses up to $25,000. And here's the really interesting thing. Even if you have a day job or you have another job, you can deduct up to $25,000 expenses against your other income. This is a great category to be in. The third and final classification of investor is when you're known as a real estate professional. And this is sort of the holy grail if you're in real estate, because in this case, you can claim all of your real estate expenses and they're all deductible against not only your own income, but if you're married, against your spouse's income as well. This is a great situation to be in because it assumes that everything you're doing is to help get you more tenants for your properties or to expand your property portfolio. And therefore, rightly so, all your expenses are able to be deducted. So let's see what it takes to qualify as a real estate professional. So the definition of a real estate professional is quite simple and clear-cut. Number one, you must perform 750 hours of real estate services during the year. Now, if you consider that a standard week is 40 hours, and if there are 50 working weeks in a year, that's 2,000 hours. So it gives you an idea of roughly what that involves. But secondly, and simultaneously, more than half of your time must be spent in real estate. In other words, if you only spend 750 or 760 hours a year in real estate, but you're also doing another 1,500 hours doing something else, then you no longer qualify. You have to spend more than half your time. Well, I can tell you most real estate professionals spend more than 750 hours a year anyway doing it because they either love it or it's so lucrative they want to do more, or it's not lucrative for them and they have to do more. But either way, it's so easy to qualify for these. And when you do, suddenly all of your expenses become deductible against other income, not only for yourself, but for your wife as well. This is really worth qualifying for. Now, in case you think 750 hours sounds ominous and onerous, it's not. When you work it out, it's only 14 hours a week, which is only 2 hours a day. And that 2 hours could be spent managing properties or looking to buy more rentals or analyzing profitability or being a realtor. That qualifies. Or doing fix and flips. Any real estate related activity qualifies. It is easy to qualify as a real estate professional. And because it's only 750 hours a year to qualify, they have to have this other rule, because otherwise you could spend 2 hours a day doing real estate, but also have a part-time job as a chef and also be a bus driver and also be an artist who makes a lot of money painting. So you have to spend at least half of your time doing real estate. Very easy to qualify. If you think you might qualify, check it out. It is worth doing. So just how much can you save by being a real estate professional? Well, obviously, it depends on your circumstances, what your gross income is and how big your property portfolio or your client base is. But someone who's earning, say, $2 million in income, if you've got $1 million of legally tax-deductible expenses that can legitimately be claimed against taxable income, then your write-off could be as great as $320,000. Now, it depends, of course, on your marginal rate and which band you're in. Taxation's progressive in this country, but that's roughly what it's going to be. Clearly, if you earn a lot less, if you're only earning $100,000, you've got $40,000 of expenses, you'll be able to pay tax on $40,000 less than you otherwise would be paying tax on. It is worth doing. You've got to get every ounce that you can get. One of the things I love about real estate is it's got very generous tax-deductible allowances. This is one of them. Another one is depreciation, which doesn't cost you anything, but you lower the tax that you would otherwise pay. Check it out. It is worth doing. Becoming a real estate professional is an obvious way of getting tremendous tax benefits. However, there are many other things you can do to benefit from investing in real estate, not only on the taxation side, but where to look for deals, how to find them, how to negotiate them. And one of the things I offer is I give you the ability to find out what I do so that you can emulate that. In fact, if you choose to, you can partner with me to find out how you can maximize your ability to generate passive income completely out of proportion to the effort required to generate that income. So click the link below and find out what the options are available to you. We can show you how to do it, or if you prefer, we can even bring deals to the table, and if you choose, you can participate in those with us. Click the link below, partner with me. Hope to see you soon. Thank you so much. So thank you for watching. Do me a favor, will you, and hit that subscribe button. It makes it easier for us to get you more videos. And keep an eye out for the next video where I'll be bringing you more content that hopefully will improve your chances of becoming financially free through investing in real estate.